Short selling. All you need to know. Explain in plain English. Short selling or shorting a stock is an advanced trading strategy that involves potentially unlimited risks. But traders who know what to look for can still use it to their advantage. In this video, we'll take a look at the basics of short selling, when you might consider it, and other frequently asked questions. Watch now. Welcome back, folks, to another edition of Sweetie Kiwi. How are you doing today? I hope you are doing fantastic. We are doing here marvelous. If you're doing as great as I am, go grab a cup of coffee or tea or vodka. Let's roll. Today I want to talk to you about short selling, one of my favorite subjects when it comes to investing. Let's first define the word or the concept here. What is short selling? Short selling is the sale of borrowed stock. So you borrow a stock. Let's say you believe that company X is going to, the share of the company X is going to fall in the next 3 months. So you borrow from your brokerage, you borrow the stock that you don't own at the moment, and you just sell it. So generally, traders sell short when they expect a stock's price to decline. This is called a directional short. People also sell short to facilitate hedging and arbitrage. But in this video, we'll focus on directional shorts. We have other shows coming that will talk about hedging and arbitrage in more advanced manner. So to start a short sale, you must have a margin account with a brokerage firm, which allows you to borrow stocks from either their own inventory or from an outside custodian bank or broker-dealer using your own eligible securities as collateral. Then you sell the borrowed security, which leaves a negative balance, a negative share balance that is then maintained in your margin account as a short position. To close the short position, you must buy back the security. If the price drops, you can buy back the stock at the lower price and make a profit on the difference. However, if the price of the stock rises, you might have to buy back the security at a higher price for a loss. A short sale goes counter to the traditional acquisition of stock that we all know, right? You buy low and you sell high. In a short sale, you have the opposite. You actually sell high and you are hoping to buy low. So here are two examples of how profit or loss is calculated on a directional short sale. Trade commissions, margin interest, and fees are not included in these calculations, folks, but they can affect final outcomes and should be considered also. Example, where you have a profit. You short 100 shares XYZ at $20, total proceeds $2,000. The stock price drops at $15, so the client buys back the 100 shares XYZ at $15. The total cost is $1,500. So total profit here, $500. So $2,000 minus $1,500. And we have the scenario where you have a loss after a short sale. So the maximum loss on a short is unlimited. Remember that. Let me repeat that, folks. Very important. The maximum loss on a short is unlimited. The short seller's losses accumulate as the price goes up, and the stock price could theoretically increase infinitely. So you want to short 100 shares of XYZ at $20, total proceeds $2,000. The stock price increases and remains as $30 until expiration date. The client buys back the 100 shares of XYZ as $30. The total cost here is what? $3,000. So the total loss here is $1,000. So $2,000 minus $3,000. Let's talk about what people refer to when they talk about a stock is hard to borrow. We have HTB. Easy to borrow. ETB means that there is a supply of a stock and generally will be available for short selling. Hard to borrow means that there is a limited supply of a stock for short selling. In this case, you'll have to pay a daily stock borrow fee, which changes based on a stock's price and its availability. How does a short sale work? Let's get into the mechanics here. Let's take a look at how a short sale of an ETB, again, this means an easy to borrow stock, might work, keeping in mind that the borrowed stocks are made available from other customers at the brokerage where you have your account, or from outside sources. Now, this we have on the screen right now, we're just showing you a very nice illustration that we got from our Charles Schwab professionals. This is really great. So positions, it shows very nicely what happens when you have a short sale. So positions before the short sale. So the long holder, let's say Armstrong here, buys 300 shares of XYZ. So the client hold position long in a margin account with a debit balance. Then the short seller, we call him Born here, enters the short sale order to short 100 shares of XYZ. So in this case, the brokerage is Schwab, will borrow 100 shares XYZ from long holder, lends to short seller, and execute the order. So the positions after the short sale, Armstrong has 300 shares XYZ, and Born has minus 100 shares XYZ. Again, these examples here are hypothetical and do not account for dividends and interest payments, taxes, trade commissions, or other fees or expenses that could reduce returns or increase losses. So what we have here is that the long holder, in our example here, the Charles Schwab example that we have on the screen, the long holder here, Mr. Armstrong, believes that XYZ stock will increase over time, and that's why he has bought those 300 shares of XYZ in his margin account. So he will receive a dividend payments on the stock. The short seller, Mrs. Bourne, if she believes the price of XYZ stock will soon decrease, she has entered, therefore, a short sale. So she has sold short 100 shares of XYZ. So the brokerage in this case, Schwab, will act as a middleman, and it will borrow the 100 shares from Mr. Armstrong to lend to Mrs. Bourne to sell. So when the short sale is executed, Mr. Armstrong account and positions remain unchanged, but Mrs. Bourne account will show a short position. Let's talk about what happens if dividends are paid on borrowed shares, because I was just telling you earlier that Mr. Armstrong, who has bought 300 shares, will receive a dividend payment. Let's just dig a little deep into that. Let's assume that a dividend is paid on XYZ while the shares are being borrowed. This happens often, especially if you have an easy to borrow shares. That means the share is very popular, the company is very popular, and stuff happens. So in that case, the brokerage institution where you have your account, they will typically allocate a substitute dividend payment to the lender, Mr. Armstrong, in lieu of the dividend, and will debit the substitute dividend payment amount from the borrower, Mrs. Bourne. In other words, what will happen is that the payment in lieu of the dividend may not be entitled to the same tax treatment as may have been applied to the receipt of the actual dividend. A lot of brokerages will make efforts to compensate lenders for any differential tax treatment. So they can basically, if you are in that position, please talk to your broker and have more questions about it, especially if you happen to be the lender of shares that are being used in the short sale transaction. Or you can even read your account agreement for more information on payments in lieu of dividends, because all brokerage firms that offer this sort of a short sale possibilities have clauses in their account agreement, in their client account agreements. They have clauses around payments in lieu of dividends. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of the Awesome Sweetie Kiwi. How you do? Oh, the Awesome Sweetie Kiwi Show. I hope you are still doing fantastic here. We're still having a conversation around this important topic, and the short sale. And if you love the content's clarity and quality so far, please consider subscribing to our channel and turn on the notification bell so you can be informed in real time whenever we drop a new show. And we drop this kind of shows every single day, rain or shine, rain or shine, rain or shine. Comment below, share, or like this content. Let's talk about what happens if the lender wants to sell the shares that have been borrowed. So if we just want to go back to the example that we showed you in the illustration before, if you remember, we have Mr. Armstrong, who has the 300 shares of XYZ, and we have Mrs. Bourne, who has sold short 100 shares, right? Let's assume Mr. Armstrong, after a while, haven't seen the market developing, haven't seen that the there has been a pretty good profit on the XYZ shares, wants to sell. So he wants to sell all 300 shares. This is important to mention, because if he were just to sell part of his portfolio, the calculus would have been different. But here we're talking about that Mr. Armstrong wants to sell the totality of his holdings. Mr. Armstrong simply places the sell order for 300 XYZ as usual. He is free to do this as he is the rightful owner of the shares. If there are additional shares available for shorting, Mrs. Bourne may continue holding her short position using those additional shares. If these shares are easy to borrow ETB, Mrs. Bourne will continue to short without any additional fees. Remember, if the shares are HTB, and we said that before, the distinction between ETB, easy to borrow, and HTB, hard to borrow. So if the shares have become HTB, Mrs. Bourne will pay a fee to continue to borrow the shares. If the sale results in unavailable shares, Mrs. Bourne's short position will be closed out via a purchase at the current market price by the broker at Mrs. Bourne's expense and potentially without notice. So this enables proper delivery of the shares to Mr. Armstrong. What I'm trying to say here is that there is a risk if you're sold short. You have to make sure that you always have an easy to borrow share catalog. That's why we always say it's important to be with the big brokerage firms and not a smaller one, because the big brokerage firms, if you have a large brokerage with millions of account holders, chances are you are going to have a broad catalog of shares you can use for short sales, so that you don't have to, so your short positions are not closed out without notice because the rightful owner of the shares wants to sell. Let's talk about, when do you have to buy the shares back? So let's say you open a short sale. In our example, we have Mrs. Bourne, Miss Bourne, who has sold 100 shares, and the question is, when does she have to buy the shares back? There are no regulations as of the date of this show that limit the amount of time a short position can stay open. However, there are two conditions that may cause a short position to be closed out. In other words, bought back. Two conditions. So if you're interested in the short sale as a risk mitigation strategy or as a portfolio risk management strategy, you need to know about the two conditions that may cause a short position to be closed out. Number one, the shares are no longer available to borrow. So when a client borrows shares to short sell, the margin lender retains the right to recall the securities at any time and without notice. If the shares are recalled by the margin lender, the brokerage will try to reborrow the securities on the client's behalf. However, and this is a big however, because it happens more often than not, if shares cannot be obtained, the brokerage is then forced to close out, buy back the short position at the current market price at the borrowing client's expense and potentially without notice. This is what happened when Mr. Armstrong wanted to sell his 300 shares, and the brokerage had to close Mrs. Bourne's short sale without a notice. So that's the first condition. Shares are no longer available to borrow. Second condition, there is an existing margin call on the account. So we have covered the topic of margin calls in another show. You might want to double check that show. But having a margin call is great if things are going right for you, and it's really bad when the things are going bad. It might sound a little trivial, a little cheesy as a statement, but that's exactly what happens. It's great. It's a great leverage tool. It allows you to multiply profits, to increase profits exponentially. But so does it when it comes to multiplying losses exponentially. So just as long positions in accounts with margin calls are subject to liquidation at the discretion of your brokerage account of your brokerage's margin department, a short position is also subject to possible closure when a margin call exists. Remember that every brokerage, every top brokerage has a margin department, aka the department that monitors customers' margin accounts. Remember that a margin account takes money that the brokerage lends to the customer, and that money the brokerage has to get it from somewhere. And the brokerage sometimes also borrows from a bank to be able to have the funds available to lend it for margin transactions. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of Sweetie Q. We're also having a conversation here around around a short sale, and I want to talk to you now about the margin requirements. Now, short selling is subject to the initial minimum 2,000 account equity requirements for using margin, which is an account level requirements, and this depends on the brokerage. Sometimes it's 1,000, 2,000, or 5,000. We've seen brokerages actually that wanted to up the ante a little bit and limit the amount of margin accounts in their portfolio. So they have raised the minimum dollar amount to 10,000. All right. Now, but for now, let's just take the example of Charles Schwab, for example. And this is one of the top brokerages out there, and let's just see their initial and margin maintenance requirements on short sales. So you have the security price. So you can see on the screen here, we have this little table, and this was as of the date of this show. So you have security price, the initial requirements prior to settlements, and the maintenance requirements. So you have initial requirements and maintenance requirements. This table, this fee schedule is kind of similar at other top brokerages. So the example here is pretty illustrative of where the industry is going. So you can see that the security price, if it's more than $16.67 per share, it has to be 50% of proceeds and 30% of market value for the maintenance requirements. If it's between $5 and $16.57 per share, initial requirements, all the initial requirements are 50% of proceeds. It's the maintenance requirements that actually change. All right. So if you have here is a basic example of an initial margin requirements. Let's say you sold short 1,000 shares of XYZ stock at $20 for a value of $20,000. You would need to have 10,000 in your margin account. That is 50% of the value. And so here we have number of shares, 1,000, price to $20. The value is 20,000, and the margin is 50%, right? Because if you look at the schedule here, again going back to the Charles Schwab fee schedule here, you need to have 50% of proceeds as requirements. So the requirement here is 10,000. 50% of 20 grand is 10,000. It's important to know that this table, as I said earlier, is a guideline. This is just a guideline. The above figures assume a margin equity requirements of 30%. However, if the margin maintenance requirement on a stock is higher, then the maintenance requirement on the short will be higher. It's also important to note that these requirements can change at any time and without prior notice from Schwab or any other broker. Folks, the bottom line here is that it's very important to remember that a short sale is an advanced trading tactic. So if you want to consider this, you have to have money, you need to have expertise, or at least have access to expertise, and you need to have an idea, a clear idea, not just a fuzzy idea. You need to have a clear idea of what you're getting yourself into and how a short sale can help you, but also the pros and cons of this kind of tactic. Let's talk now about how you can try to manage risk on a short sale, because it is important, even though a lot of the authorities and a lot of the average Joe, when it comes to retail investing, doesn't know doesn't use that tactic, the short sale tactic, it is a good one. It can be a good one. It can help you based on your portfolio management risk, based on your portfolio risk management rather, based on your asset allocation goals. So you can try to manage risk on a short sale by doing this. The potentially unlimited loss associated with the short sale makes it important to proactively manage the risk. So you need to use something called a buy stop order. A buy stop order can help manage loss on a short sale in case the stock price goes up. For a short sale, buy stop orders trigger a market order to buy back when the stock trades at or above the designated stop price. Another way to manage risk on a short sale is the trailing buy stop. So with this order, the trader can specify a percentage or dollar amount from the security's low trade price to cover their short trade. So what happens is that if the ask price only moves upward, in other words, against you, remember, if you have a short sale, the stock has to drop for you to make money. So if the ask price moves upward against the holder, the trailing stop will track the ask price until it reaches or surpasses your entered trailing amount. However, unlike the standard buy stop order, when the price moves downward in your favor, a trailing buy stop will readjust the trigger price from the new low trade price. So once you submit a trailing buy stop order, it remains in force until it's triggered by a specific price change in the inside ask price. Once triggered, it becomes a market order that's submitted for immediate execution. However, and this is a big however, folks, there is no guarantee that you will get any specific execution price or price range. The resulting execution price may be above, at, or below the trailing stop's trigger price itself. It depends on the market conditions at the moment when the conditions were met in your buy stop order. If you have high volatility, your brokerage will do its best to execute the trades within the numerical band that you have specified, but there's no guarantee. Let's take a look at an example of how this order types can help to control loss on a short sale. Again, in this example, we're not including any commission or fees, so you have to take the example excluding those fees. So let's go back to Mr. Armstrong and Mrs. Board. Mr. Armstrong shorts 100 shares of XYZ stock at 30 bucks. So initially the stock price moves down to 27, but then builds back up and ends the day at 33. So if Mr. Armstrong had no exit strategy on his trade and closed the position at the end of the day, he would end the day with what? With a loss of $300, right? That's $3 per share. Remember, he bought it at 30. The stock moved to 33. So that's -3. If Mr. Armstrong had set a buy stop on this order for 32, in other words, $2 above the sale price, the stop would have triggered when it traded at 32, and Mr. Armstrong would incur a loss of approximately $2 per share, assuming the order was filled at 32. If Mr. Armstrong had set a trailing buy stop on this order for $2, the initial trigger will take place at 32. However, as the price moved downward, the trailing stop would have readjusted with each new low, settling to $2 above 27 or $29. The thing you have to understand here is that as the price changed directions, the trailing buy stop would have tracked the upward movement until 29, at which point the market order to buy would have triggered, resulting in approximately a $1 per share, $100 gain for Mr. Armstrong. The thing here is that you have to understand that there is no guarantee that a stop order will execute at or near the stop price. There are many factors that shape the movement of a particular security, a stock, a bond, and there are also volatility. So, and you also have broker specific problems. If there is a server problem, or there is, we saw when the market was volatile back in April or back in back in March or April 2020, there are some brokers that have had some problems in terms of executed client orders. So all those things, we're saying these things in the most ideal of scenarios, but stuff happens and market conditions may be different. All right. Thank you so much for listening to this conversation. I really appreciate it. We were talking about short sales, and I was just telling you what is short selling, what does it mean to have an HDB, hard to borrow or easy to borrow. I showed you how a short sale works. What happens? We also talked about what happens if dividends are paid on borrowed shares. What happens if the lender wants to sell the shares that have been borrowed. Was to talk about when do you have to buy the shares back and what are the margin requirements and how you can try to manage risk on a short sale. I will see you next time. But until then, remember, stay marvelous.